The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alasdair MacLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alasdair MacLeod on behalf of Gold Money, and with me on the line from Chicago, I have Chris Casey, who is Managing Director of Windrock Wealth Management. Welcome to the podcast, Chris.
Yes, well, thank you for having me.
It's very much my pleasure. Now, it's quite good that I'm talking to a wealth manager because these markets are very interesting at the moment, are they not? I mean, this is we're looking at more than gold and silver. For a long time, I think gold bugs were feeling very lonely as gold was going down and everything else was going up. But now, suddenly, there's, I think, what I can only describe as violence going on. What's your take on bonds and equities at the moment?
Sure. Well, here in the United States primarily, and the odd thing about the situation today is that all the markets in the developed world are fairly closely correlated, but certainly in the United States right now, rates have moved up. We view this just as kind of a natural consequence of the Federal Reserve's policies over the last 5-6 years. Maybe they won't skyrocket from here, but certainly the long-term trend will be up. And it doesn't look good for bonds or equities for that matter.
Yeah, I mean, what fascinated me was that Bernanke just had to mention tapering and suddenly everything became destabilized. Is it really that precarious?
It's strange because the mention of tapering, first of all, no tapering is going to happen. They simply cannot taper based on the current debt levels. So they have no intention of tapering, I believe. But even if they did, that would be a good thing. It's not a bad thing. It probably makes sense to kind of revisit how the markets came to this situation and how tapering is actually considered a bad thing. And one of the things that has occurred to me over the years is that there's a lot of confusion between debt and money supply. And rightfully so, because the two are intertwined to a large degree. But really, money supply, or I should say debt, is not inflationary per se. Debt can be inflationary if securities are purchased with newly created money, or, for instance, if commercial banks lend monies out from demand deposits under a fractional reserve system. But debt in itself is not inflationary. It is, however, extremely incentivizing for central banks to monetize the debt, to basically pay back debt later on with decreased value dollars. And for that reason, the central banks, the Federal Reserve in particular, will continue to increase the money supply like they've done since 2008. So tapering really is, I think, a charade that they're putting out there in the hopes that they could eventually pull back. But I don't see that they really can. When you look at money supply since 2008, really August, I think, is when they really started increasing the money supply significantly. Depending on how you measure it, the money supply has gone up at a minimum of a third in the United States and a maximum about 260% to date. So it's really some staggering numbers.
It's rather like almost everywhere else. The other major central banks have equally puffed up their money supply, particularly Japan and the Bank of England.
It really is amazing when, especially in Japan, when the stated goal is to inflate the money supply by a given percent. I mean, anyone who's lived through the 1970s, should realize that maybe that's not a good thing. There's very few correlations out there from a macroeconomic statistical perspective that I think you can really pin down and say this is caused by a particular variable. But certainly increases in the money supply are always and everywhere result in increases in inflation in the price level.
Yeah, absolutely. I mean, I think it was one of the true things that Milton Friedman said. That was one of his quotes. But with all this expansion, don't you think that inflation is going to happen somewhere down the road? And how far away are we from it if it is going to happen? I mean, by inflation, I mean rising prices.
Absolutely. It will happen down the road. There's two questions. What is the magnitude and what is the timing? As far as magnitude, it's hard to say. I mean, I just mentioned some statistics on the general increases in the money supply. They could serve as some guidance as to how far price inflation could go. As far as timing, it's hard to say. One thing I should mention, and if you could look over the statistics historically to see this, is that inflation could happen and appear quite suddenly. So now everyone's sitting around thinking, I have maybe 30% of my portfolio is in bonds, 70% is in equities. I should be fine. I can see the inflation coming. I'll act as soon as I see the first hints. But the point is, a lot of times you can't see it. Inflation can go from being negligible one quarter to 5-6% the next quarter. So really, you have to position yourself well in advance of inflation. Go ahead.
Yeah, no, sorry. I was just thinking that, but the inflation statistics are understating the situation, are they not? I mean, I keep on quoting John Williams at Shadow Stats, but because he uses the methodology, as I understand it, that was prevalent in the late 1980s, and hasn't made all the adjustments which smooth out inflation, make inflation look less onerous than it is, and he comes up with statistics which suggests that the right rate for inflation actually should be closer to 7, 8, 9%. Yes. This is very, very different. I mean, it's very difficult, it seems to me, to define actually what's happening with prices when either the figures are rigged by the government, or alternatively, they certainly don't reflect the things that perhaps you buy. I don't know. I find over here that the inflation rate over here is considerably greater in terms of my spending than suggested by the statistics. I mean, what's your take on that?
Yeah, I totally agree with you, and I agree with John Williams and Shadow Stats in the information they put out. I mean, it shouldn't surprise anyone that the same entity which creates inflation is the same one that measures it and would want to understate it. And certainly the measures that they've taken to the various indices they use to measure it since 1980, effectively, have understated in recent years. I was just looking over maybe the last 3-4 years on Shadow Stats, and it looks like the current methodology the U.S. government uses probably understates inflation by at least 5% a year. And certainly, I agree with you. That's my experience as well. It's probably anyone's experience that goes out and actually, acts like a human in the economy and buys and sells goods. That's their experience. Back to, I was just going to mention the timing of when this inflation will really hit in earnest, even with the current statistics used by the government. It's hard to say for a couple of reasons. One is that it takes a while for the money to work its way through the system. Now, how long that takes, I don't know in particular. I know Milton Friedman years ago had mentioned maybe it's about 2 years. I frankly have never seen a really good study of how long it takes. And even if there is one, it probably becomes obsolete and it's different each time. But I would suspect we'll see something within the next 2 to 3 years very significantly. Part of what's also, I think, delaying the onset of inflation as measured by official government statistics would be that there's some deflationary forces in the works right now. So, for example, since 2008 with the recession, every loan that's called in or expires or ends has a deflationary effect to the extent it's based on originally newly created money or demand deposits by commercial banks. So there's a counterbalancing deflationary effect. In addition, though, to this deflationary effect, there's a lot of dollars held outside the system. I mean, you have everything from de facto national currencies in Panama and other countries to petrodollars, goods that are traded solely in U.S. dollars and therefore are outside the U.S. economy. So there are some mitigating circumstances that I think have delayed, but will certainly not be able to in any way ultimately prevent the onset of significant official price inflation.
Yeah, I think that's interesting, Chris. You mentioned the sort of deflationary element in the economy. If we go off John Williams' figures of, say, 7%, then the deflator for GDP would have to be adjusted accordingly. Now, if that's the case, then we have actually been in a slump, I suppose, ever since 2009. Is that not true?
I completely agree with you. I mean, to put it in perspective, in September of '08, the U.S. economy, in nominal terms, was, I think, about just over $14 trillion. And at the end of fiscal year 2012, it stands at maybe about $15.7 trillion. I mean, so that's about a 10% increase in nominal terms. Well, you're absolutely right. If you factor in the inflation as measured by shadow stats, certainly there has not been any real economic growth. If anything, we've probably had or continue to be in a recession.
Yeah. Yes, I think that's probably right. Now, what do you think the implications are of, I think what we can agree is really not economic growth, but a generally sort of recessionary background for the U.S. federal debt. And I note that this year, I think that the forecasts are for a budget deficit of about $640 billion, which is a substantial fall from last year. But is this improvement going to continue, do you think, or are we looking at just a sort of a temporary improvement and then a deterioration later?
Sure. It's funny that that's considered to be a good level of a deficit, considering that, prior to '08, I think the deficit at that time was maybe $450 billion. It's only because we had 5 straight years of $1 trillion deficit that indeed the $600 billion looks beneficial. As far as whether or not it's temporary, I would suspect it is. One thing that I think a lot of wealth managers and investment advisors miss is not just the consequences of inflation due to increases in the money supply, but also the business cycle, recessions and boom periods. And a lot of people out there who manage money never stop and even consider the fact of what causes a recession, which I think was a tremendous question that should be asked, because it has, immediate implications to really popping any bubbles that may be out there. I'm particularly, I subscribe to the Austrian School of Economics, and it's funny, I remember my Econ 101 class in college, freshman year, my textbook, and I wish I knew which textbook it was, but there was a chapter on business cycles, and it may have been 8 pages, and all they presented, in addition to the works of Keynesian theory, literally was a theory on sunspots, whether or not that somehow has a cycle on. So it's pretty amazing. But as I mentioned, I'm an Austrian. Because of that, we view increases in the money supply as having very detrimental effects, not just from a price level aspect, not just from a wealth transfer aspect, which is a direct cause of people spending dollars before the increases in prices are realized, but also has real effects on the economy, namely that it's lowering the structure and the level of interest rates, and it's causing malinvestment by a number of economic actors that eventually will have to be liquidated in what's known as a recession. So, overall, do I view this as temporary? I do. Whether that's 2 or 3 years, I'm not sure. But certainly $600 billion in a deficit is not good. And one other thing I should mention about that deficit, that's the official deficit in any given year.
Yeah.
The federal liabilities for the U.S. government are far larger than the current, $16.7 trillion that's currently recognized. When you factor in, and by the way, they've exempted themselves from factoring in these other liabilities, unlike state governments or companies or individuals for that matter. But they've exempted themselves from including pensions, from various healthcare programs, Social Security. When you factor in simply these real liabilities for existing programs, you add another $70 trillion to the official debt.
So, yes, so you're talking about these future liabilities and their net present value.
Absolutely.
Yeah. Okay.
And I think I've noticed in a previous webcast or podcast that you've performed that you've mentioned Professor Kotlikoff, who's spent a lot of time with these calculations, but 70 trillion is probably a conservative low-end estimate.
Yes, I think he was going for something like oh my goodness, I can't remember. Was it 200? No, 211 or something, wasn't it? It was huge, absolutely enormous.
I think you're right.
But there's quite I mean, obviously, with a calculation like that, you've got you've got variables which can throw up a very wide variation between one forecast and another forecast, or one estimate of net present value compared with another. But presumably this is beginning to cramp the politician's style a bit, because welfare must be becoming a substantial part of the overall budget, which reduces their ability to spend money on other things like chasing terrorists in foreign countries and so on. I mean, but I see no sign of government trying to control its spending in America. I mean, it's bizarre in a way.
It is. It's politically impossible. But you had mentioned the percentage spent relative to the budget. I've always thought that even better calculation is not the percentage of the budget that's spent on any given figure, but the percentage of tax revenues, because the budget's obviously inflated by whatever you need to borrow.
Yeah.
But tax revenues are your income, the government's income. And when you look at tax revenues relative to, say, non-discretionary spending, for the first time in history, I think maybe a year and a half ago, the U.S. passed the point where non-discretionary spending equals total tax revenues. So as you mentioned, I think you used the phrase chasing around terrorists. It's beyond that. It's really the entire defense budget is effectively borrowed, which is pretty shocking.
Yes, that is, isn't it? Right. Okay. Well, I think we can agree that's not a very happy scene. I'd like to come on to the subject of silver, if I may, Chris, because I know this is an interest of yours. And I mean, do you think silver will be a better investment than gold? I mean, first of all, do you see it as being viable as coming back as money in the event that paper money collapses or is discredited? I mean, how do you see silver in the scheme of things?
Sure. Well, let me first say that I think whether you invest in gold or silver, you're going to do well. It doesn't in some ways matter which one you invest in. But I do think having a healthy silver portion of your portfolio allocated to precious metals makes sense. It'll especially make sense, I think, if we're headed towards a 1970s type inflationary recession period. I should say, especially if it's a prolonged recessionary inflation type scenario. The reason being is that the majority of silver out there is typically mined, and I don't think there's very good statistics. It tends to be a rule of thumb, but it's approximately 70% of silver mined is really a byproduct of other mining, whether it's lead, zinc, some other metals, which means that as the economy continues to decrease and experience recessions, I think that the mining for industrial metals will eventually certainly decrease, which means silver production will decrease. So you have a declining supply of silver and presumably an increased demand simply from an investment perspective, which makes for some very nice dynamics. And there's some other reasons I think silver makes a lot of sense right now. One is that traditionally a lot of people have adhered to this 16-to-1 gold to silver ratio that exists, and I think some of that is a misconception. I think that is, in fact, what the ratio in the Earth's crust is. It doesn't mean that that's certainly what the price should be. It's also, I believe, what the U.S. government has required for legal tender laws in its history from bimetallism. But really, right now, we're looking at something, I think, approaching 70 times the gold to silver ratio. So it really is out of whack with historical norms. So if you think if anything will happen with this price of silver relative to gold, it should go up. And one last point I think that makes silver a particularly compelling investment right now is that to the extent you do have a lot of investment demand in silver, there's far less places to put it. I mean, the gold market in and of itself is significantly small relative to any equity or debt market. But when you look at silver, it's even smaller relative to gold. So when there's a rush to buy, owning silver stocks or silver funds, I think will do quite well.
Yes, and I think the situation in the COMEX market is that they're still short of silver, the commercials, whereas I think gold is more or less in some sort of balance now. So presumably when gold starts moving up, there could be quite a good bear squeeze in silver.
Yeah, that's just an additional benefit that certainly exists out there. The other benefit that's out there is that silver, and to some extent gold, but silver really is a high-tech element. Has great applications for various industries such as solar, for healthcare, and the fact that it has some great, anti-germ properties. So long term, the industrial demand for silver, I think, is just increasing due to high-tech applications.
Yes, but presumably it's price sensitive in the sense that if silver really does move up, I mean, if it moves up over $50, then it's going to make quite a lot of uses uneconomic. So that would free supply. I suppose you could say that a move up to $50 would free up the market, and it would have to do that in order for a proper market to exist. Or do you think that's being a bit optimistic and wild?
Yeah, well, it is optimistic in that there's these applications that certainly I don't view them as a reason why silver will increase. I think they're better viewed as a reason that silver has a good floor to it. But as it's another interesting concept is that as silver does increase in value, regardless of what gold does, the supply and demand dynamics for silver are very different. I mean, every ounce of gold that's ever been mined exists. And to the extent, gold continues to rise. I mean, here in the Chicago area, let alone, I'm sure, nationally in the United States, there's a, trade in your gold for cash store everywhere.
We have them all around the world. Yes.
Yeah, exactly. It's really an incredible phenomena that gold hasn't really, gold has increased quite a bit, but relative to where we think it could go, and already you're seeing these stores out there. Well, eventually, the same can't really happen with silver because there's only so much silver that exists apart from what's being consumed. And there's only so much of an above ground stock, certainly relative to gold.
Yes, I mean, I think if you go back to the 70s, which you mentioned earlier, I seem to remember that at the time of the Bunker Hunt raid, that the US government had a strategic stockpile of silver, and other countries did as well. But those stockpiles seem to have been absorbed. And as well as that, of course, the whole of the photographic industry, which was the major use for silver, that's all gone by the way. Yet, still there seems to be a shortage of silver. It's remarkable, isn't it?
It is. I mean, where photography is left off, other applications have certainly picked up.
And I suppose that if the price does rise, then I don't know. I mean, do you think it can sort of evolve into other uses? I suppose it can.
We'll have to see. It'll be an interesting situation down the road.
Yeah. Well, that's very interesting. And Chris, I'm very grateful that you took time to speak to us. Tell us a little bit about Windrock and how do we find you?
Sure. The easiest way is to simply go to our website. And I think there's some great information on there. We do a lot of research and analysis, and we believe that that's the best way to market ourselves. So if anyone visits our webpage at www.windrockwealth.com, they can certainly find us there as well as some, I think, relevant information. You can also sign up for our subscriber list for new information that comes out. But certainly our webpage is the easiest way to reach us. Alternatively, I can be reached at 312-650-9602. Windrock, just to give you a little background, we formed this company based on the current economic environment. My partner, Brent Rentmeester, and I have been discussing the situation in the United States for some time. And what's interesting is that no one else is doing this approach of using really kind of big picture macroeconomic analysis to identify bubbles and to position clients accordingly, and really kind of an entrepreneurial mindset to look at some alternative investments. No one's really doing that as far as I can tell. There's a lot of great newsletters and writers that believe in our same theories. But to really manage money, I don't, traditionally here in the U.S., it's still your conventional 70% equities, 30% bonds, almost no matter whom you go to, whether it's Goldman Sachs or some boutique down the street.
Yeah, that's amazing. Well, anyway, Chris, thank you very much indeed. And we'll watch the situation with huge interest.
Well, thank you very much.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.